When we look at the fundamentals, certainly we can point out how central banks around the world are easing monetary policy, but I want to start here with the technicals of gold and why you believe it's due for a breakout.
The reason that I believe it's due for a huge breakout is just the series of higher lows that it's put in since November, hitting that 1132 level. We saw it hit 1155 and then maintain that 1185, a level that it held most of last year. And now on this pullback, it just dipped below the 1200, about 1195. A lot of these traders see this move up as a move higher, and a lot of traders speculate that if we have any pullback in the local equity markets, especially here in Chicago and the S&P futures, if we see that VIX creep above 18, we're going to see that 1300 level in the next 2 months.
You've also talked about the inverse relationship that gold and oil share with the U.S. dollar. That's broken down a little bit over the last couple of months, though.
It really has broken down in the last 2 quarters, to be more exact. The fact is that you had oil continue to go down and the dollar continue to get stronger, but that gold still held that 1180 level that I was just talking about. The fact that it continued to hold despite the dollar going on this huge rally, that means that that relationship is a little off, and a lot of traders are speculating as shorting the gold index. Longing the gold index and shorting that dollar index, a little bit of a mean reversion trade would happen. And so that puts us in a great position for a bull run in these next 2 quarters in gold.
All right, so you're looking for a mean reversion here. I want to get back to the fundamentals for a moment here. We talked about central banks around the world. There's a lot of sovereign debt in Europe with negative yields. In fact, RBS estimates almost a third of European sovereign debt has a negative yield now. You say gold is a winner in that environment, but there's no yield there in gold except for price appreciation.
Correct. There is absolutely no yield in gold, and I don't want to make that mistake, but it becomes more and more attractive if you are a bond investor. Negative yields just don't look as good as taking a chance here on gold, especially the fact that it's been able to maintain these key levels. And a lot of traders speculate going into 2016 that the 1600 level that we haven't seen in years is once again going to come back to the table.
All right, let's talk about other factors such as India. India is the world's biggest consumer of gold, and they're making some changes here for reduction in tax on gold. What kind of effect would that have on the price?
Just what you would assume. Lowering the tax, consumption is going to go up. Not only India, China is making some moves that's going to allow consumption to continue to grow in that economy. So therefore, India and China being such big gold buyers previously, I think that appetite is going to come back to the market, once again putting a floor on gold as far as how far it can go down.
And Chris, can you quantify what that would mean for volume?
Volume, you could expect an increase of 20 to 25% actually just in the trading on some of the hedging investments. Our traders speculate on our desk. With that sort of increase in consumption, you're going to see such a appetite hit the futures that 1300 level, we think by next year is going to be a forgotten number. I think we're going to be in the 1400 to 1550 range this time next year.
That would certainly be a breakout from the trade over the last 2 years. All right, Chris Gersh, thank you so much of House Capital. Thanks for joining us on The Market.